Hello students, I am Dr. Zeba from the Department of Home Science, Aligarh Muslim University. Today we will be discussing a very important aspect of financial management, budgeting and accounting. In today's session, we will begin with the discussion on financial management in catering technology, then move on to the key aspects of financial management, followed by its significance. We will then explore basic financial terminology and concepts, learn about budgeting, its types and importance, and finally conclude with an understanding of cost structures. Let's begin by understanding financial management in catering technology. It involves strategic planning, monitoring, and optimizing financial resources while using technology to enhance catering operations. The focus is on financial health, growth, and sustainability, with all activities aligned to a tech driven catering environment. Now let's look at the key aspects of financial management. The first is budgeting, which involves developing and following budgets tailored to catering technology needs, forecasting revenues, estimating expenses, and setting financial targets in line with business objectives. The second is cost control, which includes implementing measures to manage expenses in food procurement, labor, and overhead while maintaining quality and improving operational efficiency. Another key aspect of financial management is financial analysis. This involves regularly evaluating performance by analyzing financial statements, key performance indicators, and budget variances. Such analysis supports informed decision making and helps identify areas for improvement or strategy adjustments. The next aspect is pricing strategies. Here, the focus is on setting menu prices that balance customer appeal with profitability, taking into account food costs, overheads, market competition, and the perceived value to customers. Next, we have investment decisions. This means assessing opportunities for growth and expansion, whether by investing in new technology, introducing new services, or exploring new markets. Every decision should be weighed against the potential return on investment and the risk involved. Equally important is cash flow management. This focuses on handling the inflow and outflow of cash effectively, ensuring that immediate obligations can be met and that operations remain sustainable even during seasonal changes or demand fluctuations. Moving on, another key aspect of financial management is technology integration. By using catering specific software and technological solutions, businesses can track finances, manage inventory, analyze sales, strengthen customer relationships, and gain data driven insights to improve operational efficiency. Next is risk management, which involves identifying and mitigating financial risk, addressing market fluctuations, regulatory changes, or unexpected events, and developing contingency plans to handle unforeseen challenges. Finally, performance monitoring is essential. This means continuously tracking financial performance, comparing results with goals and industry benchmarks, and assessing the effectiveness of strategies to make timely adjustments. Now, let's discuss the significance of financial management. It forms the foundation for business success and sustainability by ensuring profitability and the smart use of resources. Effective financial management helps tackle challenges such as seasonality, fluctuating demand, and competition while supporting expansion, risk management, and building investor trust. By leveraging technology, business gain valuable insights, enhance engagement, and improve operational efficiency. Overall, strong financial management enables adaptability, fosters innovation, and drives long term growth. The significance of financial management lies in its ability to sustain innovation and turn business vision into profit. It helps manage costs, pricing, and investments effectively while maintaining control through strategic budgeting. Strong financial management builds resilience against challenges and disruptions, protects workforce and supplier relationship, and ensures agility, competitiveness, and long-term growth. First, let's talk about cash flow stability. Effective financial management helps address fluctuations caused by seasonal demand or irregular events, ensuring a steady cash flow to cover expenses and payroll while maintaining funds for growth and investment opportunities. The second aspect is debt management. This involves managing loans and credit lines responsibly, ensuring timely repayment and optimizing borrowing costs to maintain long-term financial sustainability. Next, let's consider supplier relationships. Maintaining healthy and reliable partnerships with suppliers is essential. This includes negotiating favorable terms, managing accounts payable efficiently, and ensuring timely payments to keep the supply chain smooth and achieve cost savings. The fourth aspect is customer profitability. By analyzing financial data, business can identify their most profitable customers and events, target the right market segments effectively, and tailor services to maximize profitability. Next, we have employee management. Effective financial management involves controlling labor costs, ensuring fair wages and compensation, providing performance based incentives, and building a motivated, productive workforce. The sixth aspect is tax efficiency. This includes planning taxes to reduce liabilities while remaining compliant, leveraging industry specific deductions and credits, and optimizing overall financial performance through smart tax planning. Next, let's discuss financial controls. Effective financial management requires implementing strong internal controls, ensuring segregation of duties to prevent misuse, conducting regular audits for transparency, and safeguarding the business against fraud and mismanagement. The eighth aspect is brand reputation. Financial stability directly impacts a company's image. Strong financial management builds trust and credibility, attracting customers, partners, and fostering long term relationships. Finally, let's discuss emergency preparedness. Effective financial management involves building a financial cushion to handle unforeseen crises, preparing for economic downturns or disruptions, maintaining reserves and contingency plans, and ensuring business continuity during challenging times. Now we are going to learn about some basic financial terminology and concepts, starting with income. It refers to the money earned from wages, salaries, business activities, investments, or other sources. Expense means the money spent on bills, groceries, rent, entertainment, and similar items. While budget is a financial plan that outlines expected income and expenses to help manage money effectively. Finally, assets are valuable items owned by a business or individual, such as cash, real estate, stocks, or other possessions. Continuing with basic financial terminology, first one is liabilities. Liabilities are debts or obligations owed, such as loans, credit cards, or mortgages. Second is net worth, which is calculated as assets minus liabilities and served as an indicator of financial health. Saving refers to money set aside for future needs or emergencies, while investment involves putting money into assets like stocks, bonds, or real estate with the expectation of generating returns. Lastly, interest is either the cost of borrowing money or the income earned from lending or investing. Next is compound interest. Interest earned on both the principal and the accumulated interest, leading to exponential growth. Now, what is inflation? Inflation is the gradual rise in prices which reduces the purchasing power of money. Moving further, we have financial statement. A financial statement is a summary of financial transactions, mainly including the income statement, balance sheet, and cash flow statement. The income statement or profit and loss statement shows revenues, expenses, and the resulting profit or loss over a specific period. Now let's look at some more financial concepts. The balance sheet gives a snapshot of a company's financial position. It shows assets, liabilities, and equity at a specific point in time. The cash flow statement tracks the inflow and outflow of cash. It helps us see where money is coming from and how it is being used. Gross profit is calculated as revenue minus the cost of goods sold. It is a measure of how efficiently a business produces its goods or services. Finally, net profit, also called net income, is the profit left after all expenses, taxes, and deductions. It shows the true profitability of the business. Depreciation is the allocation of the cost of long-term assets like machinery or building spread over their useful life. Amortization works in a similar way, but it applies to intangible assets such as patents or goodwill. It spreads their cost over time. Finally, we have risk and return. In finance, the rule is simple. Higher returns usually come with higher risk, and lower risk often mean lower returns. We are now going to discuss about budgeting. Budgeting is a powerful strategic tool, especially for catering technology businesses. It helps managers make informed, efficient, and proactive financial decisions. With a proper budget, businesses can navigate industry challenges more effectively while also being ready to seize opportunities for growth. Most importantly, budgeting ensures long term financial sustainability. That's why it is considered an indispensable practice for success in the catering technology sector. Let's now look at the different types of budgets. Budgets are crucial for effective financial management in catering technology. Each type of budget serves a specific purpose, helping businesses plan better, allocate resources wisely, and achieve their financial goals. There are three key types of budgets commonly used in this sector: the operating budget, the cash flow budget, and the capital budget. Each of these plays a unique role in ensuring business success. First very kind of budget is operational budget. The operational budget is the foundation of day-to-day financial planning. It covers ongoing expenses along with revenue projections, whether monthly, quarterly, or yearly. Its main objective is simple: to ensure routine costs are met while still generating profit. The key components of operational budget include revenue forecast, which is based on sales, order values, and customer demand. Expense categories such as labor, food and beverage, marketing, rent, and utilities. And finally, profit margin analysis, which compares revenue with expenses to assess overall profitability. Second type of budget is event specific budget. An event specific budget is tailored for individual catering events or projects. It takes into account the menu, the scale of the event, client preferences, and all logistical needs. The purpose is to make sure each event is financially viable and profitable. It also helps in allocating resources according to the unique needs of the event while keeping profit margins in focus. The key components of event specific budget are menu cost, which include ingredients, preparation, and presentation, labor allocation, covering chefs, servers, coordinators, and other staff costs, logistics and rentals such as equipment, transport, and venue fees, and finally, profit margin analysis comparing revenue with event specific costs. Third type of budget is long term budget planning. This type of budget focuses on an extended time horizon, often with a multi year outlook. Its purpose is to align strategic objectives with financial resources to support growth and sustainability. The key components of long term budget include growth initiatives such as funding for expansion, technology upgrades, or market diversification. Capital expenditures, meaning investments in major assets like kitchen equipment, technology systems, or new facilities. Revenue projections based on market trends, customer growth, and emerging opportunities, and cost containment strategies which involve controlling expenses and improving efficiency to ensure long term financial health. Let's now move on to understand the importance of budgeting. The first point is cost control. A budget sets clear spending limits across different expense categories. It helps manage food, procurement, labor, equipment, and marketing costs. By doing so, it prevents overspending and improves overall efficiency. The second point is profitability. Budgeting allows business to track revenue projections against expenses, which gives a clear picture of profitability. It also supports smarter decisions on pricing, menu design, and overall business strategy. Third key aspect is resource allocation. Budgeting helps allocate funds according to business priorities. This could mean investing in technology upgrades, better inventory systems, marketing campaigns, or staff training. In short, it ensures financial resources are used in the most effective way. Fourth aspect is seasonality and demand. In the catering industry, demand often fluctuates between peak and off peak periods. A good budget prepares the business for these shifts, ensuring sufficient resources during busy times while keeping expenses under control during slower periods. Fifth point is investment and expansion. A well prepared budget serves as a roadmap for business growth and new initiatives. It helps assess the financial feasibility of expansions and technology investments. At the same time, it identifies funding needs and sets clear implementation timelines. Sixth is risk mitigation. Budgeting allows business to identify potential financial risk in advance. By including contingency plans, it prepares the business to navigate unexpected challenges without disrupting operations or stability. Next point on the importance of budgeting is performance monitoring. Budgets act as benchmarks to evaluate business performance. By comparing actual results with budgeted figures, managers can identify areas that need improvement and take corrective action. Next is strategic decision making. A budget provides the data needed to make proactive informed decisions. It helps guide important choices such as hiring staff or investing in new technology. Finally, there is stakeholder communication. A well structured budget creates transparency around financial goals and intentions. This strengthens communication with investors, lenders, partners, and other stakeholders. Coming up next is creating and managing budgets. When done properly, budgeting ensures financial stability, making sure that money is available where and when it's needed. It also helps optimize the use of resources so nothing is wasted. Most importantly, effective budgeting supports the successful delivery of events meeting both client expectations and business goals. Let's now go through the steps to creating and managing budgets. The first step is to understand the scope and objectives. This means defining whether the budget is for a single catering event or for an operational period such as a month or a quarter. At the same time, it's important to set clear objectives, whether it's ensuring profitability, maintaining cost control, or achieving a specific profit margin. The second step is to gather information. Here, we collect data on expected revenue, such as bookings, contracts, or regular orders. We also compile all expected expenses, including food and beverages, labor marketing, venue fees, equipment rentals, and other operational costs. The third step is to create the budget. This involves projecting revenue based on the number of events or the expected sales volume. Next, expenses are categorized such as food, labor, marketing, and rentals. Funds are then allocated using historical data, vendor quotes, and market trades to keep up the budget realistic and accurate. The fourth step is to monitor and adjust. Once the budget is in place, it's important to track actual revenue and expenses against the budget. Tools like spreadsheets or specialized software can make this process easier. If deviations occur, whether due to unexpected costs or changes in demand, the impact should be assessed quickly. Regular reviews and adjustment ensure the budget stays relevant even when circumstances change or unforeseen events arise. The fifth step is to implement cost control measures. This means applying smart cost saving strategies without compromising quality. For example, negotiating better prices with suppliers, reducing waste in operations, and optimizing staff scheduling. It is also important to regularly evaluate operations and identify areas where efficiency can be improved. The sixth step is to forecast and plan. Here, budgeting insights are used to forecast future events and operational needs. This step also involves planning for growth, keeping an eye on market trends, and preparing for potential challenges. Finally, budgets are adjusted to align with long term strategic objectives, ensuring both stability and growth. The seventh step is to communicate with the team. It's important to share budget details with the catering team and other stakeholders. This promotes accountability and encourages teamwork in managing costs and achieving revenue goals. The eighth step is to review and learn. After the budget period or event, compare actual performance with the budgeted figures. This helps identify lessons learned and areas for improvement. The feedback gained here should be applied to refine future budgets and the outcome. When all these steps are followed, the result is realistic budgets, effective resource management, and ultimately successful events backed by strong financial health. Now let's move on to understanding cost structures. The first category is food and beverage costs. This includes direct ingredients such as meat, vegetables, and spices. It also covers beverages from soft drinks to alcohol, specialty drinks, mixers, and garnishes. The second category is labor costs. Here we look at the salary, wages, and benefits of different staff groups. This includes culinary staff like chefs, cooks, and kitchen teams, as well as service staff such as servers, bartenders, and coordinators. On top of that, there are even specific labor costs which cover additional staff needed for setup, service, and breakdown. Next, we had overhead expenses. These are the costs that support operations but aren't tied directly to a single event. They include rent and utilities such as kitchen space, event venues, electricity, water, and gas. Then we have equipment and maintenance, which covers kitchen tools, utensils, tableware, and any necessary repairs. Another important category is marketing and advertising, which includes promotions, advertisements, websites, and social media efforts. We also need to consider transportation and logistics. This involves delivery and transport expenses, including fuel, vehicle maintenance, and driver wages. Event logistics also fall here, such as equipment transport, venue setup, and delivery or pickup services. Moving further, we have administrative costs. These include office expenses such as supplies, telephone, internet, and office space rental. Insurance and permits are also part of administrative costs, covering insurance premiums, license, and any legal or regulatory fees. We also need to account for waste and contingencies. Waste and spillage include costs from wastage, over preparation, or spoilage. Contingency act as buffer for unexpected expenses like equipment breakdowns or last minute changes. Finally, we need to consider profit margin. This is the desired profit, the revenue retained after all expenses, which ensures the sustainability and growth of the business. That's all for today. Thank you.